Investing in stocks can be a daunting prospect for beginners, but with the right knowledge and approach, it can also be a lucrative way to build wealth over time. Many people are intrigued by the idea of making millions from stocks, but it requires patience, discipline, and a solid investment strategy. In this comprehensive guide, we'll explore the fundamentals of investing in stocks for beginners, including how to get started, common mistakes to avoid, and strategies for long-term success. Understanding stocks. Before diving into the world of stock investing, it's essential to understand what stocks are and how they work. Stocks, also known as equities, represent ownership in a company. When you buy shares of a company's stock, you become a partial owner of that company and are entitled to a portion of its profits. Stocks are bought and sold on stock exchanges, such as the New York Stock Exchange, NYSE, or the Nasdaq. Prices of stocks fluctuate based on supply and demand, as well as various factors such as company performance, economic conditions, and market sentiment. Getting started. The first step in investing in stocks is to educate yourself about the basics of investing and financial markets. There are countless resources available, including books, online courses, and financial websites that can help beginners learn the fundamentals. Once you have a basic understanding of stocks, it's time to open a brokerage account. A brokerage account is a type of investment account that allows you to buy and sell stocks, bonds, mutual funds, and other securities. There are many brokerage firms to choose from, so take the time to research and find one that suits your needs and preferences. When opening a brokerage account, consider factors such as fees, account minimums, trading platforms, and customer service. Some popular online brokerage firms for beginners include Robinhood, TD Ameritrade, and Fidelity. Building a portfolio. Diversification is a key principle of investing that involves spreading your investments across different asset classes and sectors to reduce risk. One way to achieve diversification is by building a diversified portfolio of stocks. A diversified portfolio typically includes stocks from various industries, sizes, and geographic regions. This helps mitigate the risk of any single stock or sector negatively impacting your overall portfolio. When selecting stocks for your portfolio, consider factors such as the company's financial health, growth prospects, competitive advantages, and valuation. It's essential to conduct thorough research and analysis before investing in any stock. Investing for the long term. Successful stock investing requires a long-term perspective and a disciplined approach. While it can be tempting to try to time the market or chase hot stocks, these strategies are often unsuccessful in the long run. Instead, focus on investing in high-quality companies with strong fundamentals and holding onto them for the long term. This approach, known as buy-and-hold investing, allows you to benefit from the power of compounding over time. Reinvesting dividends is another way to accelerate the growth of your investments. Many companies pay dividends to their shareholders, which can be reinvested to purchase additional shares of stock. Over time, reinvested dividends can significantly increase the value of your investment portfolio. Managing risk. No investment is without risk, but there are steps you can take to manage and mitigate risk in your investment portfolio. One way to reduce risk is through diversification, as mentioned earlier. Another risk management strategy is to set clear investment objectives and establish an appropriate asset allocation. Asset allocation refers to the percentage of your portfolio allocated to different asset classes, such as stocks, bonds, and cash. By diversifying across asset classes, you can reduce the impact of market volatility on your portfolio. It's also essential to periodically review and rebalance your investment portfolio to ensure that it remains aligned with your investment goals and risk tolerance. Rebalancing involves selling investments that have performed well and reinvesting the proceeds into assets that may be undervalued or underrepresented in your portfolio. Common mistakes to avoid. Avoiding common investment mistakes is crucial for long-term success in the stock market. Some common mistakes that beginners should avoid include trying to time the market. Market timing is notoriously difficult, and attempting to predict short-term fluctuations in stock prices is a losing game. Overtrading. Excessive buying and selling of stocks can result in high transaction costs and capital gains taxes, eroding your investment returns over time. Neglecting to diversify. Failing to diversify your investment portfolio leaves you vulnerable to the risks of individual stocks or sectors. Letting emotions drive investment decisions. Emotions such as fear and greed can cloud your judgment and lead to impulsive investment decisions. It's essential to stick to your investment strategy and avoid making decisions based on emotions. Ignoring fees and expenses. Pay attention to the fees and expenses associated with your investments, as they can eat into your returns over time. Investing in stocks can be a rewarding way to build wealth over time, but it requires patience, discipline, and a long-term perspective. By educating yourself about the basics of investing, building a diversified portfolio, and managing risk effectively, you can increase your chances of success in the stock market. Remember to avoid common investment mistakes and stay focused on your investment goals. With time and persistence, you too can achieve financial success through stock investing. If you found this video helpful, don't forget to like, share, and subscribe for more content on investing and personal finance. Until next time, happy investing.